Good afternoon, everybody. It's Adrian Hill from Superior Accounting Solutions, and today we're going to be having our tax planning webinar for the 2021 financial year. And welcome to everybody, and thank you for giving up your time to attend. Would be an accountant's presentation without a disclaimer. So look, obviously, as per a lot of our presentations, what I'm covering today is generalized in nature, and please do not take specific action on your personal situation without seeking our advice to make sure we can personalize this information to suit your situation, because everyone's situations are very unique. We believe very strongly in this prosperity plan, whereby your business is in the middle, and that's the engine, if you like, and the combination of shares, structures, insurance, tax deductions, investment properties, and super, together with your business, is what helps you grow your wealth for you and your family for years to come. Okay, what is a small business enterprise? Well, pretty basically, it's important actually, because some businesses may not qualify. Obviously, you carry on a business. The next bit's the important bit, which is annual turnover of your business plus any connected businesses must be less than $10 million per year. And I've assumed, for the purposes of these slides, that everything's done on a cash basis, just to keep it simple. So with prepaid expenses, there's only two types of people that can do that. One is a small business entity, as just previously defined, and an individual incurring non-business expenses. And I'll go through some examples of that in a minute. All other people who don't qualify in part one, it's apportionable over the service period that you're paying for. I'll skip over that. You can read it in your time. And I'll skip over that. You can read that in your time. Okay. I'll go through some examples of things you can prepay. So a lease payment for a small business entity. So you can consider prepaying lease payments on assets such as non-luxury cars. Now, a luxury car is where the cost of the car exceeded the depreciation cost limit. For the 2020 financial year, that is $57,581. And for the 2021 financial year, it is $59,136, and computers and other office equipment and machinery. Now, the reason we say, and obviously non-luxury cars where you're under the logbook method with a high business use, because if you're leasing a luxury car, you can't claim the lease payment as a lease payment anyway. It's treated as if you financed it via a chattel mortgage or a hire purchase, and therefore your claim is depreciation and interest, whereas under a lease, your claim is the lease payment. Rent. So for small businesses, consider potentially prepaying rent on your business premises, especially where it might be owned by, say, one of your trusts or your self-managed super fund. Insurance. A small business or a landlord can consider paying their insurance premiums before the 30th of June. Interest. This is appropriate for small business and landlords. Where you've got an income producing loan or overdraft, consider organising with a financier to prepay the interest. Now, what's important with prepaying that interest is you don't want to pay it till June, because then you're maximising your 12 months claim. And second thing is you want to go to your lender and get a document from them which substantiates the fact that you've prepaid 12 months worth of interest in June, and that could be given to us to help substantiate that. Travel. Now, travel's a bit of an issue now, obviously with COVID and all that. But if you know you've got business trips coming up for you, and you're considering, what I would do is I would consider booking and paying for the airfares and accommodation before 30 June. Now, the only caveat on that in the COVID environment is with your airfares and accommodation, just make sure if we go into lockdown that you know your ramifications where you're paying things in advance. Seminars and conferences and training, etc. Same thing. Consider booking and paying for your training course, seminar or conference before the 30th of June and hence be able to claim it. But once again, with COVID, consider the ramifications if you can't end up going, because we're a long way off being out of the woods. Subscriptions. So consider paying your annual subscriptions, bring them forward and pay them before the 30th of June. For a small business or a landlord, you can pay your council rates before the 30th of June. Highly unlikely to happen, but you do have that option. Body corporate fees, same deal. If you're a small business or a landlord, you can consider paying your body corporate fee in advance. Now, if you are a landlord and you know that your rental property needs some minor equipment purchases, then why not consider potentially going out and buying those assets. Now, they can't cost more than $300 each if you want to write them off. So some common examples would be a ceiling fan, fire alarm, curtain, light fitting, microwave, vacuum cleaner, blind, etc. But important element, they can't be like assets. So in other words, you can't go and buy 4 ceiling fans for $200 each. No, that won't work. They're accumulated. Or they can't be part of a set that can't be broken up as well. So to be able to write it off, they have to be $300 or less, and make sure you pass the not like assets or part of a set. For small business, I'll skip over this because this is the old rules, and I'll go forward. Now, I want us to take a bit of time on this slide because this is a really, really crucial slide. You can see a bit of the timeline there. Now, this timeline, for all you guys that have been in business for a while, you know the asset write-off timeline's been tweaked and prodded and changed so many times over the last few years that this is the most current element of it. So I didn't put the full history. So from the 12th of March 2020 till budget night, which was deferred to the 6th of October 2020, small businesses can claim an immediate write-off for assets costing less than 150 grand excluding GST. There are exceptions to that, which we'll come to in a minute. And from the 6th of October 20, budget night, to 30 June 22, small businesses can claim an immediate write-off in the year of purchase for those assets with no dollar limit, subject to the same exclusions below. Now, the caveat to that is the budget, as you guys may or may not know, the budget has just come out recently in the last couple of weeks, and the government is wanting to extend this write-off from 30 June 22 to 30 June 23. Now, I haven't factored that in yet because it's not law, and therefore I only wanted to talk about things that are law, but you can definitively plan on having assets written off fully with some exclusions to 30 June 22, and with the hope that it'll be extended by 12 months. But when I've been conducting a lot of our tax planning sessions with our businesses that we work with, one thing I've been saying is you don't have to rush out and do it now because you've got another whole 12 months. So what I would do if I were you guys is plan, and we'll know probably in the next month or two whether you've got till 30 June 23, but at least plan up to 30 June 22 that you can potentially buy with some limitations, lots of stuff, and claim it. Even if you finance it and don't pay cash, you can still claim it. So 2 crucial things. The dates above, it's the asset has got to be installed and ready for use. So what that means, if you buy a car, then the car, you have to drive it away for it to be installed and ready for use. If you're putting in some equipment, the equipment has to be installed and ready for use for that date to be the trigger point for how that fits into the dates above. The other element is exclusions. There's two main exclusions. The above thresholds and claims exclude capital works and structural improvements. So examples of those types of expenses are hardcore building. So in other words, slabs, roofs, walls, frames, concrete, cupboards, a decent chunk of things. That the hardcore stuff you can't put these claims to, and cars. The cars are subject to the depreciation cost limit. Now, there's two there's two things you got to consider with the cars and the cost limit. Yes, there's a depreciation cost limit of 59,136 excluding GST. However, that only applies to passenger cars. So your main passenger cars and things like that are subject to those. But if you actually drive have a truck or a ute or something that's not a passenger car, not principally designed to carry passengers, and it can carry more than a ton, that exclusion does not apply, the 59,136. That only applies to passenger cars. So when you're buying a passenger car in a perfect world, if you can buy it for less than 59,136 excluding GST, that would be great. And then the claimable bit would be then subject to your logbook. You don't always have to do a logbook, and that's beyond the scope of this conversation. But if you do a logbook with a high business use, then effectively you get the business use percentage up to 59,136 ex GST as a full write-off in one hit, and the business use percentage of all ongoing costs moving forward, and also the same business percentage you get back on the BAS for GST up to this cost limit. Now, this area is a crucial area for planning because, you know, there's a lot of money at stake with buying cars and equipment and all that sort of stuff, which is why it's good to plan for the next 12 months and hopefully another 12 months for these types of transactions, and make sure you talk to us before you do it to make sure we maximize. And what I also wanted to say is we work with a lot of guys when they're doing fit outs and things for their business premises. We work with them to explain to their builder, and that we've got a process we go through to maximize what is actually capital works and what isn't, and the stuff that isn't capital works as part of your fit out can be fully written off. And it's important to get really good advice because there's a lot of mistakes made in this area. Landlords, if you buy an asset above $300 and less than $1,000, it effectively goes in the pool and it's allocated, and in the first year it gets 18.75% no matter when it was bought, and in the second year it's 37.5%. Other things, small businesses could consider bringing forward bills and paying them before the 30th of June, things we haven't covered previously. And in this lower interest rate environment, if you're looking at refinancing and you're a small business or a landlord and you've got an income producing loan and you're trying to get a lower interest rate, you can potentially refinance that loan, incur the penalty interest, claim it as a deduction, and then refinance to the lower rate as long as you refinance and incur the interest before the 30th of June. Consumables, so things like office works and stationery and other bits and pieces. The ATO rules are that whatever you buy, you're meant to consume it within 3 months, and in which case it would be deductible. And gifts, client gifts, small businesses and landlords. It's common practice, obviously, out there to offer gifts to clients and suppliers, e.g. a bottle of wine, gift voucher, etc. Now, if you want to do those sorts of things, plan for them, plan the cash flow, and go out and buy such items before the 30th of June. Super. Super's one area that a lot of accountants bang on about, but I'm not necessarily going to bang on about it. Super depends on this is where you want to have a one-on-one chat with us. What's claimable is 25 grand per person, whether you're less than 50 and 50 to 74-year-old. The important element with super is the super's got to be paid and received by the super fund before the 30th of June. So don't go and pay it on the 30th of June. If the super fund doesn't get it till the 1st of July, it's technically not deductible. So make sure that if you want to claim this, that you pay it, and the other side of it, the super entity, receives it before the 30th of June. So pay a couple of days early. You know, don't leave it till the last minute. I think the 30th of June this year is a Wednesday, so give yourself a bit of chance for the money to get across. But doesn't suit everyone, because if you're really young and you've got a business that's growing, if you put super over, yes, it's taxed at 15%, but you can't touch it until you reach a preservation age, which is a minimum of 65 years old and sometimes a lot older. So you've just got to weigh up whether you want to lock the money away or not versus the tax saving or not, and that's where you have a one-on-one chat to work that through. And super thresholds are going up a bit next year. I think they're going up to 27.5. So yeah, whoop-de-do, a whole 2.5 grand, but just so you're aware of it. There's also a strategy called the contributions reserving strategy. Now, this definitely doesn't suit everybody and absolutely has to be run past us before you go and consider it. But what it effectively allows you to do, it's possible to claim 2 years worth of super in 1 year. Now, the important elements are your super deed must allow it. Your additional year's super contribution you can't make until June. And the reason you can't make it till June is because there's a requirement that the fund allocates the contribution 28 days after the end of the month in which you make the contribution. So in other words, if you make the contribution in June, the super does not have to be allocated till the member till July, and it must be allocated by the 28th of July. Whereas if you make it in May, that means it's got to be allocated by the 28th of June, which serves no purpose. So the idea behind it is you get to claim an extra year's worth of contribution in June, but it's actually not allocated in the super fund till July. It does affect, however, the super you can claim next year, because if you do that this year, then you can't pay any super for July, August, all the way through, and you'd have to do it again in June if you want to do it. So your 9.5% super, you would not be able to make because you've already made this in advance. You wouldn't be able to do that. You wouldn't be able to make any contributions until June the following year, being a timing thing. Now, before I get into this one, all the things I've covered today, and yes, I've gone quickly, but you guys can listen, pause, fast forward, rewind, and listen, and etc. All of it will, almost all of the strategies require cash flow. Some strategies like buying assets and things you can do with finance and prepaying interest, etc. You'll have to work with your bank on that. But all things require cash effectively. And so you've got to carefully plan your cash flow and make sure whatever strategies you implement between now and 30 June, don't end up your cash flow too much that you're then struggling to fund your ongoing monthly expenses and things for your business, which is where you need to look at it carefully yourself and seek advice from a proactive accountant like us to make sure that you work through the scenarios and make sure it's appropriate for you, because what I've gone through is not appropriate for everyone. So, there's some strategies and others. Some people will use lots of these, others will use 2 or 3, others will use none. There's no right or wrong. My aim for this presentation is nothing more than giving you guys a lot of things to consider and then seeking advice from a proactive accountant to actually work through what's appropriate for you, what level, what the ramifications are, what does it mean this year, what it means next year. Now, prepaying things, one thing about it, a perfect scenario to do it would be one where, especially big one, like big dollars, would be one where your tax rate this year is going to be higher than next year. So therefore you get a much better tax advantage for prepaying stuff this year compared to next year. If your tax rates are going to be the same each year, then it comes down to an analysis of, okay, I get a benefit for saving tax this year, and what the ramifications next year, and just working through what it all means. But having said that, I'm a big advocate anyway. If you can save some tax in your pocket now, just by doing some simple strategies that are planned and quantified, and you know what the ramifications are, it's still money in your hand now, and you don't have to pay anything again for a year later. So to me, I've always been a big fan of maximising what you can, because $1 now is better than saving tax this year. Means that's a year money I don't have to pay out for tax, which then I can worry about next year, and we can do some more plans next year and see what's around. But the big one to me, aside from prepaying lots of expenses and things that we've spoken about, is the equipment stuff. Buying equipment, buying cars, getting really good advice. When you're doing fit outs, making sure the right entity's paying for the fit out, and you've structured the invoices and everything to maximise your claims and minimise your structural and capital work, so that you're maximising your full asset write-offs in your entity, which is big bucks, especially when you finance it. You get the double win of claiming it 100% up front and paying for it over time, which is, to me, nirvana. Now, the last thing I wanted to mention, if you're considering selling a property or a business, one thing you might want to consider is potentially deferring it, because when you get down to this time of the year, the important thing I wanted to highlight is down the bottom is the important bit. CGT is triggered by contract date, not settlement date. Please don't think that, okay, I can sign my contract, I'm not settling till July, so I'm all sweet. No. If you sign a contract before 30 June, the capital gain is this year, not next year, and it's the settlement date's irrelevant for CGT. So why not potentially use a put-call option agreement? Now, what that is, any decent lawyer will be able to help you with that, and if you don't have one, I can put you in touch with one. What happens is, let's say you want to sell a property or a business. You lock in, you've got a purchaser and you know what they want to buy, how much do they want to spend, what you've agreed on pricing and terms and all that sort of stuff. So rather than sign a contract, what you do is you get your lawyer to draw up a put-call option agreement. The put-call option agreement effectively locks the buyer in to your terms, the price, settlement, all that sort of stuff. But what happens is you don't sign the contract till July. So what that means is you've actually deferred the capital gain for 12 months, which is wonderful for you. And it means you can plan, the tax you've got to pay on that is now deferred for another 12 months. So it's in your pocket for another 12 months. But people have been burnt before with this. Do not spend the tax if you know you've got to pay it in 12 months. The ATO will not look kindly and are not that great and favourable about payment plans and all that sort of stuff where that situation has happened. If you know, and we can help estimate what the tax is going to be, at least put that money aside and know you can't touch it. But it might be in your offset account or redraw or whatever, and saving interest and saving whatever during this time for an extra 12 months, which, hey, it's better in your pocket than the ATO's pocket. So why not borrow from the bank of the ATO and have it for another 12 months in your pocket, but just make sure you plan for it. Now, where to put the money, we can talk about things like that, because what you got to consider is, before you just go and throw it in loans and this and that, what are the ramifications if you put it in a loan and then draw it back? Is your interest still deductible? Is it not deductible? You've got to seek appropriate advice about where to put the proceeds after you pay your debt off from the bank. What's left in your pocket, you've got to allow for the tax and all that sort of stuff. But where to park that money, you need to seek advice on too, because there is ramifications on just putting it in a loan and then pulling it out, depending on the type of loan product it is. For instance, if it's a line of credit or a redraw, the ramifications of putting money in and pulling it out can have massive ramifications on tax deductibility of that loan, with how you'd go about it. If it's an offset account, it will not have ramifications. So, but rather than just go, I think you're better off seeking advice from us and making sure that you don't have unintended consequences of your borrowings by not being able to claim a chunk of it by just moving money in and out the wrong way. You need to plan for that side of it too. We're at the end of our presentation, so thank you very much for giving up your time. I do appreciate you giving up your time, and if you need to reach out to us at all, please do. For you, all of you guys out there and all of you business owners out there that aren't currently clients of Superior Accounting Solutions, but you like how we talk and how we think and all that, because we consider ourselves a very proactive accountant and big picture accountant, and the tax return is only a really small part of what we focus on. We focus on the now and the future rather than the past, and the tax return is pretty much the past. So anyone who's interested in talking to us, we can have a free, no obligation discussion where I personally handle it and I drill in detail into your figures. We have a good chat for about an hour and a half to 2 hours, no obligation. At the end of that chat, you'll know, how we think and what we think in far more detail, and how we can, utilizing us can potentially, you can be better off, and how and why. And you can take it from there, but there's no obligation and no cost to that. So if you're interested in reaching out, please do. I'm more than happy to have a chat with you and I spend hours looking at your stuff, and then we have a good 2 hour chat about it as well. So, no harm in it. If you like what we're about and you like our mindset and all that sort of stuff, I encourage you to reach out and send us an email or give us a call, and we can, look forward to having a chat one-on-one with you. Otherwise, guys, have some fun implementing the strategies. And as I said, though, I strongly believe they've got to be personalised, and it's really important to have them personalised by someone who understands it all and understands all sides of this equation. and make sure that's factored in. But otherwise, take care to everybody, and until I chat again at our next webinar, goodbye to you all.